What I am about to lay out before you is not fantasy, not hype, not empty excitement designed to stir emotion without foundation. It is the convergence of mathematics, monetary history, industrial reality, and human psychology. It is the collision of debt, currency debasement, geopolitical tension, and physical scarcity. And when these forces converge, they do not whisper, they erupt. We are standing at the edge of a monetary transformation that few truly understand. The global financial system has stretched itself to unprecedented limits. Debt levels across sovereign governments, corporations, and households have reached heights never witnessed in recorded history. Trillions upon trillions in obligations sit like a mountain balanced on a foundation of confidence alone. And confidence, as history has shown repeatedly, is the most fragile asset of all. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Modern currencies are no longer tethered to anything tangible. They are sustained by trust in institutions, trust in policy, trust in stability. But trust erodes quietly at first. It erodes when purchasing power declines year after year. It erodes when savings lose value faster than they grow. It erodes when everyday essentials, food, energy, housing, rise steadily while official narratives insist everything is under control. The system attempts to maintain equilibrium through intervention. Liquidity is injected, rates are adjusted, new programs are introduced. But every intervention carries consequences. When money is created faster than goods and services, the purchasing power of that money declines. This is not theory, it is arithmetic. Now consider what happens when trillions of new units of currency are introduced into a system already saturated with debt. Inflation is not simply rising prices. It is the silent taxation of savers. It is the dilution of labor's reward. It is the invisible transfer of wealth from those who hold currency to those who hold tangible assets. History is clear on this point. Whenever paper systems expand beyond sustainable limits, tangible stores of value reassert themselves. Not gradually, not politely, but forcefully. Silver has always occupied a unique position in that equation. It is not merely a precious metal admired for beauty, it is money in physical form. It is industry condensed into elemental substance. It is conductivity, durability, divisibility, and scarcity fused into one asset. Markets move in cycles. Long periods of complacency are followed by sudden recognition. Underappreciation gives way to revaluation. For years, silver has lingered beneath the radar of mainstream enthusiasm. It has been treated as secondary, overlooked, even dismissed. Yet beneath the surface, structural pressures have been building. Debt cycles do not unwind gently. When debt expands beyond productivity growth, either productivity must surge dramatically or currency must absorb the imbalance. Productivity cannot magically accelerate at the pace required to offset the scale of obligations accumulated. That leaves currency. And when currency absorbs the shock, it weakens. As purchasing power erodes, investors begin seeking assets that cannot be conjured from digital entries. They seek tangibility. They seek scarcity. They seek durability. Silver stands at the intersection of monetary protection and industrial necessity. Unlike purely monetary metals, silver is consumed. It disappears into electronics, medical equipment, energy infrastructure, and advanced manufacturing. It is used in solar technology, electrical systems, high-performance components, and emerging innovations. Much of it is not economically recoverable once deployed. That means supply does not simply accumulate endlessly in vaults. A significant portion is permanently absorbed by industry. Now pause and consider the implications. A metal that is both a store of value and a critical industrial input. A metal whose above-ground supply is finite. A metal whose production growth has stagnated while technological demand accelerates. Supply is constrained not by policy, but by geology. New mining projects take years, often more than a decade, from discovery to production. They require capital, labor, regulatory approval, infrastructure, and energy. Meanwhile, existing mines face declining ore grades and rising costs. Demand, on the other hand, is accelerating. Industrial expansion, electrification, renewable infrastructure, and advanced manufacturing are increasing the baseline requirement for silver each year. This is not speculative demand, it is embedded demand. It is engineered into the circuitry of modern life. Add to that the monetary dimension. When economic uncertainty rises, when inflation persists, when currencies wobble, investors look for hedges. Gold often captures headlines first, but silver historically moves with greater volatility. It amplifies monetary flows. When capital rotates into precious metals broadly, silver's smaller market size means price movements can become explosive. This is not conjecture. It is observable pattern behavior repeated across decades. Markets accumulate tension quietly. During accumulation phases, informed capital builds positions methodically. Volume may not appear dramatic. Price may drift within ranges. Public interest remains subdued. But beneath that calm surface, pressure builds. Then comes the catalyst. Sometimes it is policy. Sometimes it is geopolitical instability. Sometimes it is a banking tremor. Sometimes it is simply the realization that inflation is not retreating as promised. When that realization spreads, demand shifts rapidly. Investors who are comfortable holding cash begin reallocating. Funds flow into tangible assets. Physical inventories tighten. Premiums rise. Availability shrinks. Because silver's market is relatively small compared to global capital pools, even modest reallocations can produce outsized effects. Imagine a reservoir behind a dam. Water accumulates steadily. Pressure increases gradually. The structure appears stable until it is not. When release occurs, it is not incremental. It is forceful. Silver's structural setup resembles that reservoir. On one side, constrained supply growth. On the other, expanding industrial necessity. Above it all, an overextended global monetary framework vulnerable to shocks. The combination is combustible. We are witnessing the late stages of a historic debt expansion. Interest rate manipulation, liquidity injections, and fiscal stimulus have prolonged the cycle. But prolonging a cycle does not eliminate its conclusion. It magnifies it. As confidence fluctuates, volatility increases. Investors become more sensitive to risk signals. Bank fragility, currency fluctuations, sovereign credit concerns. These elements do not operate in isolation. They interact. When confidence cracks, safe haven flows accelerate. Silver is not merely reactive to crisis. It anticipates it. Price movements often begin before headlines catch up. By the time public awareness peaks, much of the initial revaluation has already occurred. And here is where timing becomes critical. The most substantial gains in any bull market occur during the early expansion phase, after accumulation but before mass participation. Once mainstream enthusiasm ignites, volatility increases dramatically. Late entrants chase momentum, often entering near temporary peaks. The opportunity lies before recognition becomes universal. Right now, the ingredients are aligned. Currency debasement is no longer theoretical. Inflation has reshaped household budgets worldwide. Debt servicing burdens are rising as interest rates adjust. Governments face difficult trade-offs between fiscal restraint and economic slowdown. Industrial demand for silver continues to climb structurally. Renewable energy infrastructure requires significant silver inputs. Electrification initiatives expand usage. Technological integration deepens reliance. Mining supply cannot pivot instantly to meet sudden surges. Years of underinvestment in exploration limit rapid expansion. Meanwhile, investor sentiment remains cautious. Public discourse does not yet reflect urgency. That is precisely what defines early-stage opportunity. Markets reward foresight, not reaction. Consider the psychological arc of every major commodity bull run. Skepticism dominates early. Observers cite reasons why price cannot rise. Supply appears adequate until it is not. Demand appears manageable until it exceeds forecasts. Then comes recognition. Recognition transforms into enthusiasm. Enthusiasm morphs into acceleration. Acceleration can become mania. Silver has demonstrated this pattern repeatedly. Sharp advances compress years of gradual appreciation into months of rapid ascent. Because silver's dual role, industrial and monetary, creates nonlinear behavior. Industrial consumption reduces available float. Investment demand tightens it further. Feedback loops emerge. Rising prices attract attention. Attention attracts capital. Capital pushes prices higher, reinforcing narrative strength. And in an era defined by digital communication and rapid information dissemination, recognition spreads faster than ever before. The global financial system is more interconnected now than at any previous point. Shocks propagate quickly. Capital reallocates instantly. The velocity of market reactions has increased. This amplifies both risk and opportunity. When safe haven demand surges in a digitally connected world, flows can overwhelm thin markets rapidly. Silver's total annual production value is small relative to global equity and bond markets. It would require only a fraction of portfolio reallocation to produce dramatic price shifts. That asymmetry is powerful. At present, many investors remain positioned heavily in financial assets, equities, bonds, derivatives, assets priced on assumptions of stability and growth. If confidence wavers materially, diversification into tangible assets could accelerate swiftly. And silver sits at a historically favorable valuation ratio relative to other hard assets. Historically, such ratios revert, often violently. None of this requires apocalyptic forecasting. It requires simple acknowledgement of structural imbalances. Debt is high. Currency expansion is ongoing. Industrial demand is rising. Supply growth is limited. Investor allocation to silver remains comparatively low. When these variables intersect, price does not drift gently. It reprices. Preparation, therefore, is not about panic. It is about positioning before repricing. The coming bull run in silver will not announce itself politely. It will begin subtly, tightening inventories, rising premiums, strengthening technical patterns. Then it will accelerate. And those who understood the convergence beforehand will not be surprised. They will be prepared. Now let us move deeper into the mechanics of what happens when structural imbalance transitions into full-scale bull momentum. A bull market of historic magnitude is not a straight line. It unfolds in phases. Each phase has distinct characteristics, distinct psychology, and distinct opportunity. The first phase is stealth accumulation. This is where informed capital moves quietly. Physical supply is acquired methodically. Large buyers avoid drawing attention. Price may rise modestly, but volatility remains contained. Media coverage is minimal. Skepticism persists. We are witnessing the late stages of that phase. Premiums in physical markets fluctuate unpredictably. Delivery times lengthen during demand bursts. Industrial users secure longer-term contracts to protect supply chains. These are early signals. The second phase is recognition. Price begins breaking through long-standing resistance levels. Technical traders identify momentum. Financial commentary shifts tone from dismissal to curiosity. Retail investors begin asking questions. At this stage, gains can be rapid but still rational. Pullbacks occur, but higher lows form. Confidence builds among participants. The third phase is acceleration. This is where historic bull runs are defined. Momentum compounds. Capital inflows increase dramatically. Physical inventories become visibly strained. Headlines turn urgent. Price swings widen. Volatility intensifies. During acceleration, the speed of repricing shocks observers. What once seemed expensive becomes the new baseline. Targets once considered unrealistic become conservative. The final phase is exuberance. Participation broadens to those previously uninterested. Speculation becomes aggressive. Short-term traders dominate flows. Price overshoots intrinsic value temporarily. Understanding these phases allows strategic positioning. The current global environment is primed to push silver from stealth accumulation into recognition and potentially into acceleration faster than many anticipate. Consider inflation dynamics. Even when official measures suggest moderation, lived experience often contradicts it. Persistent price increases in essentials alter behavior. Savers grow cautious. Investors seek hedges. Inflation, once embedded, is difficult to reverse without significant economic contraction. Policymakers face constraints. Tightening too aggressively risks recession. Loosening risks currency weakness. This tension creates uncertainty, and uncertainty fuels demand for tangible assets. Now integrate geopolitical tension. Resource nationalism is increasing. Trade relationships are shifting. Supply chains are being restructured for security rather than pure efficiency. Silver-producing regions are not immune to political shifts. Export controls, taxation changes, regulatory hurdles, all can disrupt supply unpredictably. Markets price uncertainty aggressively. Add the energy transition. Electrification initiatives require vast quantities of conductive materials. Silver's unmatched conductivity makes it indispensable in high-efficiency applications. Substitution is limited in many advanced technologies without sacrificing performance. As renewable infrastructure scales, baseline industrial demand ratchets upward. This demand is structural, not cyclical. Even if global growth slows temporarily, strategic investments in energy security and electrification persist. Thus, silver's demand floor rises over time. Meanwhile, above-ground stockpiles are not infinite. Much historical silver has been consumed irretrievably in industrial processes. Unlike gold, which is largely hoarded, silver is both hoarded and consumed. This dual nature tightens effective supply more than surface statistics suggest. Now layer on financial leverage. In paper markets, derivatives allow price exposure without physical delivery. In calm markets, this functions smoothly, but during supply stress, the divergence between paper claims and physical availability can create volatility spikes. If physical demand intensifies while paper positions remain heavily leveraged, short covering dynamics can amplify upward moves dramatically. This is not unprecedented. Commodity markets have demonstrated similar behavior when supply tightens unexpectedly. Another critical variable is investor allocation. Precious metals occupy a historically small percentage of diversified portfolios compared to previous inflationary eras. If even a modest reallocation occurs, driven by inflation hedging, diversification strategy, or loss of confidence, the influx of capital into silver could overwhelm available supply. Remember, markets are marginal pricing systems. Price is set at the margin where buyers and sellers agree. When sellers retreat because they anticipate higher prices, and buyers increase urgency, the clearing price rises sharply. Now imagine this process occurring simultaneously across industrial users securing supply and investors seeking protection. That convergence is powerful. Technically, long-term chart structures reveal compression patterns. Periods of sideways consolidation often precede breakouts of magnitude. The longer the consolidation, the greater the stored energy for expansion. Silver has spent extended time building such a base. Momentum indicators, supply metrics, macroeconomic pressures all align toward potential breakout conditions. But timing requires decisiveness. When breakout occurs, hesitation becomes costly. Early-stage pullbacks become shallow. Each dip is met with stronger buying. Liquidity thins on the sell side. Retail participation typically increases only after substantial appreciation has already occurred. Preparation, therefore, is strategic rather than reactive. Risk management remains essential. Bull markets include corrections. Volatility can shake conviction. But structural bull markets driven by fundamental imbalance ultimately trend higher through volatility. Patience during accumulation and discipline during acceleration define successful participation. The magnitude of the coming move will surprise many, precisely because silver has been underestimated for so long. For years, narratives have focused elsewhere, on equities, on digital assets, on growth sectors. Silver has remained comparatively quiet. But quiet markets can harbor explosive potential when fundamentals shift decisively. Consider also currency diversification trends globally. As nations seek alternatives to concentrated reserve structures, precious metals regain relevance as neutral assets not tied to single sovereign liabilities. This macro shift enhances long-term demand stability. And remember, markets move ahead of consensus. By the time broad agreement forms that silver is in a historic bull run, price will have already adjusted significantly. Opportunity resides before consensus. We stand at a junction where debt saturation, inflation persistence, industrial expansion, constrained supply, geopolitical tension, and investor underallocation intersect. Such alignment is rare. When rare alignments occur in markets, outcomes are rarely modest. They are transformative. The stage is set. The pressure is building. The imbalance is undeniable. History teaches that when monetary strain meets physical scarcity, repricing is not gradual. It is explosive. The coming bull run in silver will not wait for universal agreement. It will reward preparation, conviction, and foresight. The question is not whether this shift will unfold, but whether you will recognize it in time and position yourself before momentum turns into history.